We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. Brian here with us today and going solo and didn't bring another advisor on with him. Brian's ready to handle it all today on his own. You can always go to the website, DeckerRetirementPlanning.com, to find out more about Brian and the team, where the offices are. There's a lot going on at Decker Retirement Planning, but the idea is they're here to help you figure out where you are on that road to retirement. Can I retire? Do I have enough? Will my money last? Are we going to be okay if we retire? Those are the types of questions that Brian and the team at Decker Retirement can help you figure out. They don't know if they can help you until you reach out, so there's no cost to chat with them. 833-707-3030 is the number. No cost, no obligation, no pressure. I think it's a great opportunity for you to find out, maybe get some of those questions answered. Do we have enough? Are we going to be okay? Will our money last? All those types of things. And there's no cost to do so. 833-707-3030. We'll give you that number throughout the program. But again, you can always go to DeckerRetirementPlanning.com. Brian and his team have put on the website, besides learning more about Brian and the team, tells you about events that are upcoming, all that kind of stuff. But it also has an educational site just for you. It is under the heading, when you go to DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. There are 12 different things you can download, including Brian's book on retirement, The Decker Approach. There's the 3 Principles of Retirement book, the Checklist Challenge, Sample Income Plan. Those are just 4 of the 12 different things you can download. Again, that is on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. Brian, how are you? You ready to go?
Good, Mark. How are you?
I am doing very well. And we're going to talk today about really kind of the psychology of money. And there's a book by that same name by Morgan Housel. And I don't know if people, I wouldn't know Morgan Housel from anywhere. So here's what I'm going to tell you about Morgan Housel. We're going to get into kind of the brain and how we think about money and all of that. Brian's going to walk us through some areas of this, the psychology side of our brain when it comes to money. But just so you know, Morgan Housel wrote the book, The Psychology of Money. He's a partner at Collaborative Fund. He is a former columnist at The Motley Fool and The Wall Street Journal. And it's really an interesting book, I think, when you think about how we think about money. So I guess, Brian, where do you want to go? Because we all have the fear of missing out, or, hey, follow the herd, all that kind of stuff. But where do you want to go today?
I'm going to split this into 3 parts, Mark. One is to take the psychology of money and specifically apply it to the stock market first for retirees. And then I'm going to go into retirement planning and having a retirement plan and apply the same points to having a plan as being in the stock market, the psychology of money, applying that to a retirement plan. And then the third thing, I'm going to talk about the principal guaranteed or the fixed income side of the market. So we'll hit all 3, Mark. But I want to start with the stock market in general. Would it surprise you, Mark, if I tell you that the next 10 years are not going to be like the last 10 years?
Well, not really, I guess. No. The last 10 years were really good on the market, by the way.
Yep. And
the 10 years before that weren't very good. 2000, 2009, they weren't very good.
Let me up the standard on this. With 100% certainty, I'm going to tell you that the next 10 years are not going to be like the last 10 years. So there's been 4 times that the S&P 500 is traded above a market valuation of 30 times trailing earnings, only 4 times. 1, 1929, it took 17 years to get your money back. Second was 1964, 18 years to get your money back. Third, November of 1999, 14 years to get your money back. Fourth time was November of 2021, we hit 32 times trailing earnings. And if history repeats, the markets, any passive investment strategy of buying and holding stocks, mutual funds, indexes, or ETFs, they will have their ups, they will have their downs, but they will go net nowhere for the next 10 to 15 years. I tell you that with 100% historical certainty. So what do you do? What do you do? Buying and holding is not going to produce a return that funds your golden years of retirement if history repeats. And history has been 100% on this. So there's a chart, Mark, that I bet you know about called the Callan chart. And this is worth jotting a note if you're listening on the radio, Googling this. The Callan chart shows for the last 20 years what the leading sectors of the market have been. So let's pick one, Mark, real estate. Let's say the REITs, you wanted to be involved in the REITs because they have done very well. Or you read an article that says that they're going to do very well. And so you buy them and you just hold on to them. Well, how are you going to do? Well, the last 20 years, you did very well in 2003 and 4, and even 2005 and 6. In 2007, they were down 7%. And then in 2008, the average REIT was down 70%. Same thing with technology. In 2022, technology on average was down over 30%. If you didn't own technology and semiconductors in the last 18 months, any return that you had, you can cut that down by about 80%. So there's a time to own technology, semiconductors, real estate, small caps, emerging markets, fixed income. There's a time to own them and a time not to own them. Now, I'm leading up to a point. In retirement, two very important things. One, as far as risk goes, I think, this is just my opinion, but a 60-40, 70-30 portfolio is insanity. We quantitatively reduce our clients' risk to about 25%, with 75% on average having zero risk. Not a 60% risk portfolio, 40% bond fund portfolio. Now all your money is at risk. In fact, in the last 3 years, bond funds that your banker and broker advisor said was your safe money has lost you over 30% because of interest rate risk. We've had an interest rate cycle where, Mark, from 1940 to 1980, the 10-year treasury went from 2% in 1940 up until almost 15% 1980. And then 40 years of declining interest rates. Now, owning bond funds in a declining interest rate environment is fine. You make money on the gain that you make plus the yield. But in 2020, 40 years later, the 10-year treasury was at 0.47%. That means that interest rate risk was extremely high. And yet bankers and brokers would tell you that's where you put your safe money. Why? Because, well, we've always done it that way. That's nonsense. It's demonstrably financial incompetence to recommend bond funds when the 10-year treasury is at 0.47%. So predictably, since then, the last 3 years, interest rates have gone up and bond funds have lost a lot of money. Here's my point. There's a time to own bonds, time not to own bonds, a time to own small caps, time not to own small caps, et cetera, et cetera. So there's something in retirement investing that you need to know about, and it's called sector rotation strategies. It's also called momentum. And a third name for it is called relative strength. In relative strength investing, every stock is given and assigned a relative strength score 0 to 100, and you own the top performing stocks based on relative strength. So let me give you an example. In 2000, 01, and 02, the S&P is down 50%, NASDAQ's down 70%. And during that 3-year period, if you owned momentum strategies that use relative strength scoring and sector rotation, you would have owned what was going up. Well, for those 3 years, real estate, gold, silver, energy, pharmaceuticals, biotech, healthcare, all of those stocks made double digits each year for those 3 years. Instead of getting hammered in the market, you would have made money all the way through there. And then the markets bottomed in March of 03. And what did you rotate into? Well, for 4.5 years, what exploded to the upside were small caps, emerging markets, technology, and semiconductors. Then you rotate into 2008. The way momentum investing works is if something is not going up, relative strength has you in cash. If everything's going down, you are in cash. And so in 2008, you own cash and you own treasury bonds. Treasury bonds were up over 20% in 2008. That is called sector rotation. Now, what we did at Decker Retirement Planning for our clients, we were in an investment committee meeting one day, and Mark, you know how you have just a conversation that leads to an epiphany? We were like, you would be talking about golf. I was talking about skiing. I said, as a skier, the worst thing you can do is buy all around skis. They do everything poorly. What you want to do as a skier is you want to have powder skis. You want to have giant slalom or GS skis for the pack, and you want to have crud skis. Now you've got your bases covered and you can have an enjoyable day, look and see what the conditions are, what you're going to ski, take the right skis out, and go have an awesome day. Well, what we were doing is we were expecting 5 managers to be fantastic in up markets and down markets. Well, that was stupid. So we split it. When the market is trading above a 200-day moving average, by definition, in an uptrend, we own the top performing sectors of the market by virtue of using momentum strategies. So Jake O'Shaughnessy's book, What Works on Wall Street, page 367, Appendix A, that is where we pulled our information, biggest study ever done since 1950. And he shows not the top 1, 2, or 3, but the top 15 strategies in an up market. All of them are momentum, sector rotation, and relative strength investing. So we did that. We've done our homework. We pulled the best relative strength investing managers, momentum managers, and we plugged them in for the offensive side of the field. But when the stock market crosses the 200-day and starts a downtrend, instead of expecting the offense to play defense too, we pull the offensive team off the field. We put the defensive team on the field. These are 4 hand-picked momentum strategies that it was a perfect laboratory for us to find these in 2022. In 2022, S&P was down 19%, bonds were down 20%, NASDAQ was down 33%, commodities across the board were down with one exception, and that was energy. The frackers, the drillers, the pipelines, the natural gas and crude oil companies all were up 15 to 20%, and they made good money when the average portfolio was down 30% and the average bond fund was down 20%. So we simply have an offense and a defensive strategy. Now, back to what I said at the top of the show, Mark, the next 10 years are going to be different from the last 10 years. And if people in retirement do their homework, this will make sense to them. There's a time to be in technology and a time to be out of technology. Sector rotation allows very good returns in up markets. And then when the markets start down, we use different set of momentum strategies on the downside, allowing us historically to make money in down markets. These managers that we use made money in 2008, 2015, 2018, 2020, 2022. Those are all the down markets. I threw COVID in there in 2020. Actually, 2020 was an up market. But Mark, that strategy is very important for retirees to know about, because if the markets become flat over the next 10 to 15 years, active management is the only way that they can do well in retirement in up markets and down markets.
Yeah, and we've all heard this saying, I think, when you're talking about the markets, for example, is past performance does not guarantee future results. That's kind of what Brian's talking about. If you look at the Callan periodic table of investment returns from 2004 to 2023, real estate was the top, 2004, 2006, 2012, 2014, but it was the bottom in 2007, 2020, 2022. So they're all over the place. It's really kind of interesting to look at it. The last 4 years, it's been large cap and small caps have been pretty good. either number one or number two or number three. So they've all been pretty good. So things are always changing. And the way Brian and the team at Decker Retirement do this is it's not one area and we just go all in and let's hope for the best. No, it's about being able to move and be adjustable and be quick-footed, if you will, to change because the times are always changing. So where do you need to be? You have questions about this because this can get super complicated, I think. It's why Brian and the team, I think, use these computer trend models to kind of help guide them. 833-707-3030, 833-707-3030. We're talking about financial traps to avoid on the program today, and Brian's got a lot more to get to. I wanted to make sure you have the opportunity to talk with the team. If you want to learn more about this, how does this affect you and maybe your portfolio? 833-707-3030. Back with more of Safer Retirement Radio with Brian J. Decker of Decker Retirement right after this.
Legacy planning is more than just numbers. It's about the impact you leave on generations to come. Let Brian Decker guide you in creating a lasting legacy. Call Brian and the team at 833-707-3030 to start your legacy journey.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. You can always learn more on the website, DeckerRetirementPlanning.com. If you go to the heading of Safer Retirement Education, there's about 12 different things you could download, including Brian's book on retirement, The Decker Approach. It's just information for you. And then maybe you'll have some questions after perusing through that, seeing what you want to learn more about. You might want to talk to him. You can do so. There's no cost. 833-707-3030, 833-707-3030. We're talking about 4 financial traps to avoid today. And there's a book by Morgan Housel. And if you don't know who he is, he's a partner at Collaborative Fund. He's a former columnist at the Motley Fool and the Wall Street Journal. But he wrote a book called The Psychology of Money. And it's how we think about money. And Brian, I know all the stuff that you just went through, you're now going to kind of compare it to what you do for your clients, right?
Right. So I'm going to apply the tests that we just talked about to the equity strategy that we used. Now, just if you didn't catch the first segment, there's been 4 times that the S&P 500 has traded above a market valuation of 30 times trailing earnings. And each time when that's happened, the markets have traded flat for 15 plus years. It happened in 1929, 17 years of flat, 1964, 18 years of flat, 1999, 14 years of flat, and then 2021. And so we expect a flat market cycle. Buying and holding passive investment strategies in retirement are not going to work, and they'll hurt you. It's devastating to have flat market returns for 10 to 15 years. So we use momentum strategies that rotate into whatever the highest relative strength scoring individual stocks and sectors and indexes are, and we hold them until something better comes along, and then we rotate into that. We referred in the first segment to the Callan chart that shows the different segments of the market, how real estate has years when they've done very well, and real estate when they've done horribly poorly. So there's a time to be in technology and time not to be in technology. So now let's apply Morgan Housel's 4 points to our strategy. The first point is the FOMO, fear of missing out. avoid jumping on a bandwagon trends with money you need, and set aside some that you can join in with, but have a plan for most of those funds. So when it comes to investing in risk, I mentioned that we think it's insane for banks and brokers to tell someone in retirement to put 60 or 70% of their nest egg in the stock market. They take one hit of 30 and 40% and they have to go back to work, or they have to dramatically change their lifestyle. When you draw income from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down. When you do what we do, which is draw income from laddered principal guaranteed accounts, you can go through a year like 2022, S&P down 19, bonds down 20, NAS down 33, commodities were down, and our clients did not lose a dime in their principal guaranteed accounts. In fact, we made money. So that's very, very important. But FOMO, fear of missing out, when we test it against the momentum, relative strength, and sector rotation strategies, we don't have a problem, Mark, because we're always in what is going up the fastest. So far this year, there's been a lot of technology exposure, cloud computing stocks, NVIDIA. We've held Google and Meta. Those are the stocks, some of the Magnificent Seven stocks, but there's a time to be out of some of those. We haven't owned Tesla in a year. And so there's a time to be in those stocks and a time to be out. FOMO, we don't worry about it because momentum strategies has us investing in the top performing stocks. There's going to be a time, Mark, when technology is getting crushed and gold, silver, commodity type of investments are going to be doing well. Energy, well, it happened in 2022. So FOMO, check that box. We don't have to worry about that if you embrace the strategy of momentum investing.
So how does that all work? How do you always be in something that's going up? Because at some point it's got to go down. You can't be right every day. I mean,
the way it works, this is a good question, Mark. The way it works is relative strength scoring allows us to be in the top. We're a math-based firm, and it's an algorithm that has us in the top performing sectors and individual stocks in the S&P and the NASDAQ and the indexes and the sectors of the market. We have 5 different momentum strategies. And so that our clients don't worry about FOMO because the algorithm keeps us in the top performing stocks. There was a time when you wanted to own Tesla and a time to be out of Tesla. Right now, you don't want to own Tesla. So that's number one. The number 2 is the illusion of certainty. Nothing is certain. And so that, again, is a benefit for sector rotation. I'll never forget at the end of 1999, a client called me, Sun Valley client. He said, Brian, I don't know why I pay you any management fees. All I need to do is buy technology and biotechnology and let her rip. And I called his bluff and I said, Lewis, is that what you want to do? There was silence. He said, no, that doesn't make sense. If he would have done that the next 3 years, 2000, 01, and 02, he would have lost 70% of his money. So on this point number 2, the illusion of certainty, you get sucked in thinking, all I've got to do is buy technology and let her rip. Well, 2022, the average portfolio was down 30%. Now, when you take a hit like that in retirement, what are you going to do to make that up? You're going to go back to work. You're going to sell your home. You're going to move in with the kids. You can't afford to take hits like that. So we understand that. And that's why we use sector rotation, relative strength, and momentum strategies for our clients that are in retirement for our risk strategies. Now, the third one is the cost of impatience. I pulled up a chart. Now, we have 5 different managers, Mark. How would you feel if your first year with us, this is just one of the managers, but let's say they're not, but let's say that they're all the same. So let's say your first year with us was, I'm looking at this, 2011. You were down 3.4%. Would you be impressed?
Probably not when I'm down. No.
No. Well, let's say you get frustrated after a year and you're out. Do you know what the next year that manager was up 87%? Well, let's say that the first year you were with this manager was down 7.2% in 2008. Would you be happy then?
Would not.
Wait, no, you'd say yes, because the markets were down 37%. You were down 7.
Yeah, I wasn't down that bad. Yeah, okay.
Okay, but let's say that you weren't. You said, geez, Brian, you said you were so good. I lost 7% on my money. Well, the next year it was up 79%. So well, here's another one. 2018, would you be happy being up 1.8%?
The market wasn't very good that year, though.
No, it was flat.
Maybe I guess I was.
But you had high expectations. Here's my point. The cost of impatience is huge because after 2018, 2019 was up 29.5%, the manager. Now, these are offensive managers. This is one of the 5 offensive managers that we use. The defensive managers have not had a losing year in 2008, 2015, 2018, 2020, 2022. But I just pulled one to make this point. The cost of impatience is huge. Find out why you own what you own or how the strategies work and stay with it, because there's going to be some flat years. Who is the guy? John Templeton. I mean, some of the greats, investors, Warren Buffett. Warren Buffett has had some flat years and years that he's lost money, but if you would have stayed with him, you would have done very, very well. Find the strategy that you want to work. Now, Warren Buffett is a buy and hold investor. By the way, he just sold Apple, all of his Apple. Did you know that, Mark?
I did not.
Yep. He over the weekend, the Oracle of Omaha announced that he sold his entire Apple position. That sink in.
Well, he's getting close to 90. He probably wants to take some trips, needed some cash.
That's probably it.
But I get that. The idea, we all know it's not timing the market, it's time in the market. So when you get to retirement, you don't want all of your money sitting in the market, but the part of money, the portion of the portfolio you do have in the market, you need it to be as positive as you can make it. And there's no guarantees ever. But this is a great opportunity for you to sit down with Brian and the team at Decker Retirement and kind of figure out where you are. There's no question. Some people love taking the risk. Others want no risk. And so everybody else falls in between, right? So Brian and the team, when they create plans for their retirees, it's about whomever they're sitting down with. Some are more comfortable with more risk. Others are not. Others are kind of, well, if I lose this, I'm okay with that. But the idea is it's about you. How can Brian and the team help you kind of put your portfolio together that makes the most sense for you? 833-707-3030. No cost for you to chat with the team. 833-707-3030. This is a great opportunity to have a team working alongside of you. 833-707-3030. Back with more with Brian J. Decker of Decker Retirement. Back with more after this.
In the world of taxes, knowledge is power. Let the team at Decker Retirement Planning empower you with the insights and strategies needed to navigate the complexities. Dial 833-707-3030 to stay ahead of the tax game.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Always learn more on the website, find out about upcoming events, find out more about the team, DeckerRetirementPlanning.com. Questions, concerns, man, I think I've got enough. I think we're good to retire. I think we're going to be okay, but you don't know. Why not sit down with a retirement planning team like Decker Retirement Planning? Find out. There's no cost to talk with them. 833-707-3030. Because the more you know, the better decisions you can make. And Brian and the team are here to help guide you through that. 833-707-3030. I'm Mark Elliott. Glad you're with us. We're talking about four financial traps to avoid. And this is according to Morgan Housel. Morgan is a partner at Collaborative Fund. He's a former columnist at The Motley Fool and The Wall Street Journal. And he wrote the book, The Psychology of Money. And so, Brian, you were walking through those 4 financial traps. You got through 3 of them. I don't know if you want to go over the other 3, those 3 again, but you got the 4th one to get to.
Yeah, the first 3 real quickly, and we're focused on Morgan Housel's Psychology of Money on specifically the equity or risk side of your portfolio in retirement. In retirement, you cannot afford to take a 30, 40, 50+% hit. If you do, you have to go back to work, move in with the kids, sell the home. You got to go to plan B because you can't make that up. In your 20s, 30s, 40s, 50s, you can take a hit like that because you have time and your income is coming from work. So if you take a hit like that every 2 weeks, your 401k gets clobbered down 50%. And every 2 weeks, you're putting new money into a down market and you hold. So you've got 3 to 5 years for the markets to recover. You're all good. In fact, you're better off having dollar cost averaged into a down market. You can't do that in retirement. The rules of investing are totally different. So I mentioned at the top of the radio show that the next 10 years of the market, historically, with 100% accuracy, using historic data, we expect a flat market. There's been 4 times that the S&P 500 has traded above 30 times trailing earnings, and each time that's happened, markets have been flat for a long time. 1929, 17 years. 1964, 18 years. November of 99, 14 years. November of 2021, we hit 32 times trailing earnings. So that means that buy and hold strategies, they're called passive investment strategies, buying and holding stocks, indexes, mutual funds, and ETFs, with history says will yield a 0 return. So we use momentum strategies that use relative strength scoring to keep our investors in the top performing stocks, indexes, and sectors. When something stronger comes along, we rotate into this. This is called sector rotation. It's called relative strength. It's also called momentum. I want to bring up, and we talked about FOMO being a problem with retirees in their investment strategy, fear of missing out, thinking that all the time you got to own technology. Well, if you do that, shame on you, because you're going to get nailed. In 2000, 01, and 02, technology got crushed. In 2008, technology got crushed. 2015, 2018, 2022, the NAS was down 33%. The average portfolio in 2022 was down 30%. There's a time to own technology and a time not to own technology in semiconductors. So we use sector rotation that keeps us in the top performing sectors and out of the ones that are going down. So FOMO is not a problem for this strategy because our clients don't have the fear of missing out. They're investing in the top performing stocks and sectors. The illusion of certainty, that nothing is certain, to diversify your investments. That's important. And we diversify our clients, making sure that their risk exposure is not a ridiculous 60, 40, or 70, 30 portfolio. Our clients have 75% of their portfolio on average no risk, 25% of their portfolio with risk, and using these sector rotation strategies. The cost of impatience we just talked about at the end of last segment. Staying with a strategy that you understand, you've done your homework, it makes sense to you, seeing it work. You can have a flat year, and then, as I mentioned in the last segment, the next year the manager just kills it. So just know that even the best strategy can have a flat year. The last one is avoiding gullibility. Now, Mark, I can think of no better story when it comes to gullibility than something that happened in a seminar a couple years ago. We were at a nice restaurant, had the slide deck up, going through the PowerPoints. And at the end of the show, I thought we'd made our points pretty clear, and walked up to a table, and the guy said, "Hey, I'm not going with you. I'm going with this other guy. He promises 7% a year for 10 years and 4% for life." And I said, "Let me tell you what that means." And I hope radio listeners listen very carefully, because I think we're performing a community service by pointing out that the king has no clothes here. 7% for 10 years guaranteed and 4% for life. Here is a perfect example of when it sounds too good to be true, it usually is. So let's say, Mark, you put 100 grand into this strategy in 10 years, and let's say you're 65 years old. So 100 grand, 10 years, grows at 7%, it doubles. So now it's 200 grand. You're now 75 years old. Mark, you feeling okay now?
Feeling okay, yeah.
Okay. Now 4% for life, 4% of 200,000 is 8,000 a year. So you start to get 8,000 a year at 75 years old. Simple math, 8,000 into 100 to calculate how long it takes for you to get your original investment back. By the way, that's 12 and a half years. Now you got to be 88 years old before you start to make a profit. Now, how do you feel about it?
Not as good as I was feeling, but I do have $8,000 a year to live on, I suppose.
Mark,
Just
your
extra
return
cash.
has a zero return for 22 years. That the answer would be, how about no, that's awful. Okay, so avoid gullibility. Do your homework. And I would say go to several different retirement planning companies and see if they make sense to you. By the way, most all of them, well, I'll just mention, I would write this down also. There's 6 key points, in our opinion, there's 6 key points to a final retirement plan. One is to have a plan. A pie chart is not a plan. A pie chart is a diversification, modern portfolio theory description of how well you're diversified. It is not a retirement plan. So don't let anyone fool you when a banker or broker tells you that that's their plan. That's not a plan. A retirement plan shows your income sources from Social Security, from pension, from wages, from rental real estate, and then it totals it up minus taxes, and you can budget and see what the next year is for net of tax annual income and monthly income. And we plan out with a COLA, cost of living adjustment, to age 100. We know you probably won't live to be age 100, but we want you to outlive your money. Then on the portfolio side of the spreadsheet, you have laddered principal guaranteed accounts. So you can go through some horrible times geopolitically, economically, interest rate wise, and you sail through that with tremendous peace of mind. Your income is being drawn from laddered principal guaranteed accounts. And in the 20 years that you're drawing from the laddered principal guaranteed accounts, you have a risk account that's invested so that it grows and replaces what you have spent in 20 years. Have it make sense to you. So number one, you have a plan. Number two, tax minimization strategies. Tax minimization strategies are vital so that you minimize what you're sending to Uncle Sam. And by the way, I'm going to go through a quick list, but for most people, the Roth conversion strategy is number one. By far, that's going to be where most people save the most money. And it needs to be done correctly. We don't have time to go into that, but what about donor advised funds so that you can offset a big spike in taxes in one year because you've exercised stock options? How about paying no capital gains and using a charitable remainder trust? What if you've got a big age difference with your spouse? Well, we would use a quadro to benefit you in your life. What if you don't want to pay any estate taxes, state or federal? We would use an ILIT, an irrevocable life insurance trust. If you have huge gains in company stock in your 401k, we would use net unrealized appreciation to minimize the taxes there. What if you want to pass on assets to your grandchildren? Do you know about the generation skipping tax of 48%? Well, there's a way around that. You can use the dynasty trust. If you own rental real estate and you want to see that become tax-free, we use cost segregation. If you are in your 60s and you're still working and coming up with huge income-producing investments, what about a GRAT to move those funds over to the next generation? And I've just scratched the surface. Now, if your advisor is not talking to you about those strategies, you are shortchanging yourself and you need a new advisor, in our opinion. Tax minimization strategies are number two to have a proper final retirement plan. Number three is risk reduction. Risk reduction is where we quantitatively lower your risk from the disaster of 60-40, 70-30 portfolios that banker brokers recommend to a more common sense 75-25. 25% of your portfolio is at risk, 75% has no risk. So we quantitatively lower your risk. We reduce your risk another way by strategically lowering your risk and using momentum strategies with an offense and a defense. When the S&P is trading in an uptrend, we use 5 different momentum strategies, making good money because we're cherry picking the best parts of the market using momentum strategies. When the S&P starts a downtrend and crosses the 200-day moving average, we rotate into a defensive strategies. These are hand-picked managers, momentum managers that have made money in the most difficult down markets in the last 25 years. And then third, we eliminate interest rate risk. We are not going to use bond funds in a rising interest rate environment. And in our opinion, anyone who does recommend bond funds in a rising interest rate environment is committing financial malpractice in their recommendations. But that is number 3. Number 1 is to have a plan. Number 2 is tax minimization. Number 3 is risk reduction. Number 4 is what really sets our company apart. As fiduciaries to our clients, where we are a math-based firm, we do our homework, we optimize, this is number 4, we optimize every part of the portfolio, every part. We do our homework, we use the Wink database on a monthly basis and look to find what the highest earning principal guaranteed accounts are from banks and insurance companies. So our clients using money market accounts to keep their money, keep their cash available, their emergency cash. What do we use? We use the Fidelity money market at 5.1%. We want to ladder in some CDs. Well, so we ladder in 3 years at around 5.7%, 5 years at 6%. And then we have 7 and 10-year principal guaranteed accounts where variable rate investments are doing much better. And we have AI indexes that are just killing it. And those returns are well over 8.5%, 9% average annual returns for 7 and 10-year principal guaranteed accounts. And then we've already talked extensively in this radio show about why we use what we use on the risk side. So number 4 is optimize every part of your portfolio. Number 5 is if we are minimizing taxes, optimizing your portfolio and minimizing risk, by default, we are maximizing your net of tax monthly income. That is crucial. And then the last one is fee minimization. The average retiree in the United States is paying 1% in fees. Our clients on average are paying 70% less than that, 0.3%. So if you've written that down, make sure to avoid gullibility by looking around, comparing what you've got, and making sure that that's a match for what you are looking for. But those are the 4 strategies that Morgan Household recommend, 4 different points of making sure that you are doing the right thing in retirement. And we focus that just on the risk side.
Right. FOMO, fear of missing out, the illusion of certainty, cost of impatience, and avoiding gullibility. 833-707-3030 if you'd like to learn more. How does all this pertain to you, maybe? That's be a great thing to think about. And you can always ask the team at Decker Retirement, 833-707-3030. Totally complimentary, no cost to you, 833-707-3030. Back with our final segment of today's Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning, right after this.
Crafting your legacy is like planting seeds for a future forest. Let's nurture your vision together. Speak with Brian and the team at Decker Retirement Planning at 833-707-3030 to ensure your legacy grows strong.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Again, you can go to the website, DeckerRetirementPlanning.com, to learn more about Brian and the team, but you can also find out about upcoming events. You can also go there to pick up Brian's book on retirement, The Decker Approach. Under the heading of Safer Retirement Education, there are 12 different things you can download that Brian and the team think that you might be interested in learning more about. 3 Principles of Retirement book. There's a checklist challenge, sample income plan, plus Brian's book, The Decker Approach. That's just 4 of the 12 things you can download. And that's all there for you at no cost. It's just there for you to hopefully increase your knowledge of retirement. And then if you have questions, call the team. There's no cost. 833-707-3030. 833-707-3030. Brian, as always, you've gone through a lot of things today. I've got one quick question because I know you're going to talk about, because we're talking about the risk, the portfolio, the Morgan Housel, the author of Psychology of Money, talking about the fear of missing out, the illusion of certainty, cost of impatience, avoiding gullibility. So you're going to compare that to the other side of your really practice your portfolios for your clients. They have the risk side, but they also have the safety and protection side. But here's what I have a question for you to start with. Then you go into all of that. And that is, you always say that Decker Retirement is a math-based firm. But people are they have emotions. So how does emotions figure into all of this when you're going, well, wait, here's the math, here's what the math says. And you're like, well, I don't think I like that. It doesn't, the emotions are a part of us, right?
Yeah, that's true. Being a math-based firm, it lets us run the numbers and to see if that investment makes sense. So Mark, let me give you 4 examples. One is a variable annuity. I was sitting, relaxing on the beaches of Maui one day. I'll never forget this. This is about 10 years ago. Relaxing on the beaches of Maui, and this guy puts his blanket down next to me, and we start chatting and find out he's in the retirement planning business. He asked me what I do. I give him some information, and then he tells me what he does. He said that he puts all of his clients in Allianz. And I go, what? Why would you do that? He says, well, they pay the highest commissions, of course. And if I put enough of my clients in Allianz, they contribute to my 401k. Mark, just immediately, I got up and I grabbed my towel. I just wanted to take a shower. I couldn't believe he said that. I just hope that people do their homework. A lot of bankers and brokers will let me give you an example. So a lot of bankers and brokers will tell you that they are fiduciaries. A fiduciary is someone who is required by federal law to put the client's best interest before their company's best interest.
Yeah, so they're not fiduciaries, but you all have at Decker Retirement, have a fiduciary responsibility.
Well, I'm going to give radio listeners 3 ways that they can jot down to find out if their banker, broker, advisor is a fiduciary or not. Number 1, they have to be independent. Independent means that they can work with any of the strategies and investment vehicles out there. Mark, if you deal with Merrill Lynch, what mutual funds are you going to get?
Merrill Lynch's.
If you work with Fidelity, what kind of mutual funds will you get?
Fidelity.
Vanguard?
Vanguard.
Okay. Is that in your best interest? Heck no. So we do our homework to make sure what strategies work best. Last radio segment, we talked about portfolio optimization. But number 1, there's 3 different ways that you can find out if your banker, broker, advisor is a fiduciary or not. Number 1, they have to be independent. The company has to be independent. Decker Retirement Planning is an independent company. Number 2 is they need to be Series 65 licensed. Series 65 licensed is someone who cannot take a securities commission. All of their fees it's a fee relationship. So let me give you an example why that's important. I'll just give you my opinion. The most abused securities are the following, in my opinion. Variable annuities, got to be one of the worst investments out there. High fees, banker, broker gets about 7% right up front, gets paid every year you own it. The mutual fund companies get paid every year you own it. And the insurance companies get paid fees every year you own it. 3 layers of fees that usually add up to 5 to 7% a year before you make a dime. We don't like them. We don't use them. Why would you buy a variable annuity that has no downside protection when markets go down? And so many mutual funds and ETFs and indexes are much better. I don't get it. I want to warn people to stay away from variable annuities, number one. Number two, the highest commission product out there are called non-traded REITs. I just talked to a client last week about this. He was gullible and he bought a non-traded REIT. Well, the commissions on those are 15% typically. They don't price it for 3 years to avoid you the heart attack of seeing 15% come out of your money right off the top. And there's a time to own real estate and a time not to own real estate. And if your timing isn't great, you are going to take a major hit with an illiquid investment for at least 7 years. So we don't like them, we don't use them, and we hope that you do not buy a non-traded REIT. With all the other liquid REITs out there that have as good or better performance than these non-traded REITs, in our opinion, there is zero, none, not a reason to buy a non-traded REIT, period. Number 3, this is so slimy, Mark. These are called C-share mutual funds. C is in Charlie. This is where your banker, broker, you tell them, I don't want any upfront commissions and I don't want any back-end commissions. They say, yes, sir, yes, ma'am. And they put you with no disclosure in a non-traded REIT. What just happened? Well, you've got 12B1 fees that just doubled your fees from 1 to 2%, and you never were told. By the way, you were never told, or there's no disclosure either on the commissions for variable annuities or non-traded REITs. You can do all these things as a Series 7 licensed advisor. And then on the radio show earlier, I told about the ridiculous buy this annuity that gives you 7% guaranteed for 10 years and 4% for life, where the bottom line is you make no money for 22 years. If you live that long, you'll be lucky to just get your money back. So we don't like these. We don't use these. These are 4 different examples, horrible, dishonest, in my opinion, examples in our industry that you can do as a Series 7 advisor. If a Series 65 advisor did any of those, they would be fined, warned, and written up. So it's a different standard, but that's number 2. Number 1 is for your banker, broker, advisor to be a true fiduciary, they have to be independent, common sense. Number 2, they have to be Series 65 licensed. If they're Series 7, they are not a fiduciary by definition. And oh, by the way, some of these advisors are duly licensed. They have a Series 65 and a Series 7. So Mark, if I'm a Series 65 and a 7 licensed advisor, how are you going to know when I'm talking out of the Series 65 side of my mouth? And how are you going to know when I'm talking out of the Series 7 side?
I have no idea.
You can't know. The last point is you've got to have a company with a structure as RIA, Registered Investment Advisory Firm. Decker Retirement is a Series 65 RIA that's completely independent. We are a pure fiduciary. If your banker and broker tells you that they're fiduciaries and they fail one, probably all 3, but even one of those tests, they are not fiduciaries, and they can do to you without disclosure some of the examples that I gave. So that's a long-winded response, Mark, but to avoid gullibility, to make sure you do your homework, the cost of impatience, the illusion of certainty, and FOMO we've covered in this radio show can cost you dearly in choosing your advisor and the retirement planning plan and the investments that you fund your plan with. Be very, very careful.
So Brian and the team are really here to help you figure it out. Brian, remember Brian's talked about the old 60-40 or 70-30, not as far as stocks and bonds, but as far as how much money do you have at risk versus how much safe money you have. And maybe it makes sense that you have 70% at risk and 30% safe, but maybe it makes more sense if you flip those maybe. Maybe you're retired. Maybe it should be 30% that's at risk and 70% is safe. Don't know. Brian doesn't know. The team doesn't know at Decker Retirement. They're here to help you figure out how your portfolio should be set up for you and your life, and what you're wanting to do. How you're going to, what are you going to do? How are you going to spend your time? Think of putting that puzzle together. The key is the picture on the box. That's how it starts with Brian and the team at Decker Retirement. They need to know the picture on your box, and that would be, what are you going to do in retirement? How are you going to spend your time? Are you going to travel? Not going to travel? How much income do you need? What's going out? All of that, they're here to help. If you'd like to learn more about your situation, I think it's a great opportunity. There's no cost to you. It's 833-707-3030 to chat with Brian and the team at Decker Retirement. Great opportunity. Great opportunity. Boy, I think I've got enough. I hope I've got enough. Call them. Find out. 833-707-3030. Maybe you're a little shy in this area. Maybe you're a little heavy over in this area. I don't know. Brian doesn't know. Wouldn't you like to find out? 833-707-3030. 833-707-3030. Brian, as always, enjoyed it. Enjoy the rest of the weekend. Have a great week. We'll do it again next week.
You too, Mark. Thank you.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.